Hello, everyone. Thanks so much for joining us today. My name's Audrey, and I'm here today with Trevor, Nick, Kyle, and Jack. And together we make up Team MG24 for ECN 502. Over the past week, we've been looking into the U.S. banking and financial services industry, specifically how competitive it really is and what's shaping that today. We've picked this industry because it impacts almost everything we do, from how we save and spend money to how businesses grow and invest. But even though it's such a huge part of the economy, we notice that a lot of the market power is concentrated among just a few big banks. So we wanted to dig into why that is, how it affects consumers and smaller institutions, and what can be done to make the system more competitive and more fair. And we'll break down all of that for you today as we go through the presentation. So here's a quick glance at what we'll be covering today. First, we'll start by giving a quick overview of the US banking and financial services industry, just to set the stage and explain how it's structured. Next, we'll dive into the level of competition within the industry by looking at how concentrated it is, what role fintechs are playing, and how regulation shapes the market. And finally, we'll wrap up with some suggestions on how the industry could become more competitive and more accessible, especially for smaller banks and consumers. So, with that, I'm going to pass it off to Kyle, who's going to get us started with a quick look at the industry itself.
Thanks for that, Audrey. Now let's begin by introducing the U.S. banking and financial services industry. This sector sits at the center of the American economy, providing the credit, payments, and investment channels that keep businesses and households running. It's also incredibly diverse, covering everything from traditional commercial banks and credit unions to investment firms and fast-growing fintech companies. Over the past few decades, the industry has evolved through waves of regulation, deregulation, and technological disruption. Today, it's both highly innovative and increasingly consolidated, which raises important questions about fairness and access. In this presentation, we'll explore how competitive the industry really is, what forces shaped its current structure, and what kinds of policies might make it more balanced and inclusive for both consumers and smaller institutions. Looking at the current snapshot of the U.S. banking sector, we can see several major themes. First, the industry remains extremely concentrated, dominated by a few very large banks. Competition exists, but it's uneven. Larger institutions benefit from scale and brand trust, while community banks and regional lenders face higher costs and tighter margins. At the same time, technology is transforming how customers interact with financial services. Digital banking, mobile payments, and AI-driven credit tools have become essential expectations rather than bonuses. So when we ask how competitive the market is, we also need to consider accessibility, who gets to participate, and who gets left out. Policymakers are increasingly focused on how to open the market, encourage innovation, and ensure that the benefits of finance reach more people, not just the biggest players. The market structure of the U.S. banking tells a story of concentration in numbers. Just four major banks, JPMorgan Chase, Bank of America, Citigroup, and Wells Fargo, now control about 44% of all industry assets in a market valued at more than $24.1 trillion. That dominance brings efficiency but also raises competitive barriers. These institutions enjoy advantages such as economies of scale, advanced digital infrastructure, and strong capital positions. They also post strong performance indicators, a return on asset of about 1.1% and a net interest margin near 3.3%. Those figures sound modest, but represent billions in annual profit. Meanwhile, smaller banks struggle to keep pace with compliance costs, digital investments, and talent retention. Overall, the structure reflects a market tilted towards large incumbents, stable but less dynamic for new entrants and underserved communities. This slide acts as a bridge between the current market snapshot and the historical context that explains how we got here. This structure we just saw didn't emerge overnight. It's the result of decades of policy change and market evolution. Over time, the U.S. banking system has moved from a fragmented network of local banks toward a smaller number of nationwide giants. Technology, regulation, and economic crisis all played major roles. By tracing that evolution, we can better understand why competition looks the way it does today, and what trade-offs policymakers face between stability, innovation, and inclusion. So in the next slide, I'll walk through some of the key turning points that shaped the modern banking landscape, from the deregulatory moves in the 1980s to the crisis-driven consolidation of the 2000s. The evolution of U.S. banking over the past 40 years shows how policy and crisis shape today's concentration. In the 1980s, deregulation removed interest rate ceilings and loosened restrictions on competition. While this encouraged growth and innovation, it also sparked a wave of mergers. Then in the 1990s, the Interstate Banking Act of 1994 allowed banks to merge across state lines, creating truly national financial giants. The 2008 financial crisis intensified consolidation even further. Many smaller and mid-sized institutions either failed or were absorbed by larger ones under the too big to fail logic. As a result, the total number of banks fell dramatically from about 14,000 in the 1980s to fewer than 5,000 today. This history highlights the constant tension between efficiency and competition, and it sets the stage for understanding the industry's challenges moving forward. Now I'm going to pass it on to Jack with the analysis of competition.
Thanks, Kyle. Spinning off of the historical evolution of the U.S. banking industry, I will further expand on the market consolidation and competitive disruptions that have reshaped the industry into what we know today. Banking consolidation in the U.S. has brought both advantages and drawbacks. On the positive side, large banks benefit from economies of scale, allowing them to spread technology, compliance, and innovation costs more efficiently. However, smaller community and regional banks often face higher relative costs, making it difficult to compete. The imbalance has created what economists call banking deserts, areas where, particularly in rural communities, where residents have limited access to in-person financial services. Overall, consolidation has enhanced stability among the largest institutions but has also reduced competition and access to the broader banking landscape. This chart visually captures the trend of consolidation we just discussed. As shown here, in 1980, the top 5 U.S. banks held less than 25% of the total market share. By 2024, that share has more than doubled, while the presence of community banks has shrunk dramatically. Mid-sized banks have also lost ground, squeezed between the scale advantages of the largest institutions and the niche roles of local banks. This illustrates how market power has concentrated at the top, driving economies of scale but reducing competition and local access, the same dynamic that contributes to the growth of so-called banking deserts. As consolidation has limited competition among traditional banks, a new wave of competitors has emerged: fintech firms. These digital-first companies like PayPal, Chime, SoFi, and Square are redefining how financial services are delivered. Without the need for physical branches, they offer faster, more accessible, and often lower-cost alternatives for consumers. In 2024 alone, fintech investments exceeded $43 billion, reflecting strong investor confidence in this sector. The goal is not only to innovation and customer retention, but collaboration, creating a new form of competitive coexistence between established banks and disruptive newcomers. Interestingly, the relationship between banks and fintechs isn't just about competition, it's also about collaboration. Recent FDIC research shows that many banks are now partnering with or investing in fintech startups to bring innovation directly to their operations. This chart illustrates that trend clearly. Around 60% of banks partner with fintechs in payments, where digital speed and convenience are key. In lending, the picture shifts. 55% of banks prefer to develop in-house solutions, keeping tighter control over credit and compliance. For banking as a service, about half of banks collaborate externally, while wealth tech partnerships remain smaller but steadily growing. These patterns reveal a hybrid strategy, where banks blend collaboration with internal innovation, creating a financial ecosystem not by rivalry alone, but by mutual growth and coexistence. Next, I'm going to hand it off to Trevor to discuss consumer impacts.
Thanks, Jack. My name is Trevor, and I'll be starting with effects on consumerism. The net interest margin for Q4 2024 sits at 3.3%, slightly above the pre-pandemic average of 3.25%. In a competitive market, margins typically shrink as efficiency improves and consumer rates improve, but Philippon shows the opposite. U.S. banks have maintained high spreads even as technology lowers operating costs. This persistence reflects rents for incumbents, meaning established banks capture excess profits instead of passing savings to consumers. Consumer priorities are shifting, with 44% of consumers identify digital capability as a deciding factor in choosing a bank. This indicates that while consumers value innovation, the market's concentration limits meaningful differentiation. Most large banks offer similar digital tools, leaving little room for smaller entrants to compete. As Philippon argues, reduced competition doesn't just raise prices, it stifles innovation and slows consumer benefit from technological progress. There's a disconnect between digital adoption and competitive gains. This chart shows digital banking adoption rising from 40% in 2010 to 90% by 2024, yet interest rates spread barely declined. This demonstrates a great reversal effect. Even as technology advances, financial efficiency has stagnated because dominant banks face limited competitive pressure to lower costs to improve terms. Philippon emphasized that in Europe, stronger competition policies have ensured that digital progress leads to lower cost, which is a contrast to the U.S. experience. Technological innovation alone cannot guarantee consumer benefits in a concentrated market. Takeaway applies directly when markets lack competition, innovation becomes a branding tool, not a driver of better prices or success. Moving on to regulation and oversight. So the key agencies are the Federal Reserve, the FDIC, the OCC, and the CFPB. Their overlapping roles ensure stability but add complexity that favors large banks. Philippon notes that this creates barriers to entry for smaller firms and fintechs. So the major laws, you have the Dodd-Frank from 2010 and Base 3, strengthen safety and transparency of 2008. However, compliance costs often reinforce big bank dominance. Philippon argues that regulation meant to protect consumers can also reduce competition. Moving into banks versus fintech oversight, banks face strict layered supervision, fintech oversight is fragmented. This allows incumbents to exploit regulatory gaps, a form of regulatory advantage that Philippon warns about. Regulatory capture is that large banks often influence policy, shaping rules that protect their power. Philippon calls this regulatory capture, where oversight serves incumbents over consumers. Key takeaway is oversight is vital, but excessive complexity and weak enforcement limit competition. I am now going to be passing it on to Nick, where he will go into suggestions. Thank you.
Thank you, Trevor, for those great insights. To wrap up our analysis, I'll outline several policy actions that could help make the U.S. banking system more open, innovative, and inclusive. First, implementing open banking and API data portability would let customers securely share their financial data across institutions. This would reduce switching costs and force banks to compete on service quality rather than customer lock-in. Second, strengthening antitrust review of large bank mergers is essential. By applying stricter scrutiny, regulators can prevent further concentration and preserve diversity in financial institutions, especially community and regional banks that promote local lending. Third, creating regulatory sandboxes for fintech startups would allow them to test new technologies like AI-driven credit tools in a controlled environment. This balances innovation with customer protection and helps promising firm scale responsibility. Finally, supporting community banks and fair data sharing rules ensures that smaller players aren't excluded from digital ecosystems. These measures expand financial access in underserved or rural areas while preventing big banks from dominating emerging fintech partnerships. Collectively, these reforms would strengthen competition, foster innovation, and promote equitable access to financial services. With that, I'll hand it back to Audrey to close out our presentation. Thank you.
So I am back again to wrap things up. And what we found is that the US banking and financial services industry is highly concentrated, with a few very large institutions holding most of the market share. That concentration has its roots in decades of deregulation and consolidation, and it continues to shape how competition works today. At the same time, fintech companies are shaking things up, bringing new technology, improving access, and also pushing traditional banks to innovate. But even with all of that change, big banks still hold most of the power, and switching or entering the market remains tough for small players. Now, overall, our takeaway is that the system could benefit from some balanced reforms. Things like open banking, stronger antitrust review, and more support from community banks to make it more inclusive and competitive without losing stability. And just like that, we're at the end of our presentation. Thank you so much for taking the time to listen and engage with our work. Really appreciate it. This project also gave us a chance to dig deeper into how competition actually works in the US banking industry. And it's been a great learning experience for all of us. We're so happy to answer any questions or hear your thoughts on what we found. And once again, we're Audrey, Trevor, Nick, Kyle, and Jack. Thanks again for joining us.